Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5, one idea at a time. I'm your host at AlgoBot, and in today's lesson, we're exploring an expert advisor called Random Walk Index Trend Emergence. This strategy is built on a clever statistical tool, the Random Walk Index, designed by Michael Poulos. It's a trend-following approach that aims to tell the difference between random market noise and a genuine trend taking shape. By the end of this video, you'll understand the indicator, the entry and exit logic, and the actual code that makes it run. Let's get started. So what exactly does this expert advisor do? At its heart, Random Walk Index Trend Emergence is a trend-following system. The central question it tries to answer is a deceptively simple one. Is the market actually trending right now, or is it just drifting around randomly? To answer that, it leans on a concept from statistics. Over a stretch of, say, 10 bars, a purely random market is only expected to wander a certain distance, roughly the square root of the number of bars, multiplied by the typical size of a single bar. If the market has actually moved much farther than that random expectation, then the movement is probably not random at all. A real trend has emerged from the noise, and that is what this strategy aims to detect and join. The indicator driving all of this is the Random Walk Index, or RWI for short. It uses the average true range, the ATR, as its measuring stick for a typical bar's size. Then it looks across a whole range of lookback lengths and measures how far price has really traveled compared to what randomness alone would predict. When the real movement clearly exceeds the random walk expectation, the strategy takes that as a sign of an emerging trend. This approach is designed for liquid, trending instruments. Think major foreign exchange pairs, gold, or stock indices, on timeframes ranging from intraday all the way up to swing trading. It runs on whatever single timeframe you attach it to. It also keeps its parameter list short and its ranges broad, which is a deliberate choice to resist overfitting to past data. Remember, though, this is educational information only, not financial advice. Trading always involves risk, and losses are part of the process. Let's walk through the mechanics step by step. Everything begins with the average true range, calculated over a period of 14 bars by default. This gives the strategy a single number that represents the typical size of one bar. Think of it as the strategy's ruler for measuring movement. Next comes the heart of the Random Walk Index. The strategy looks across a whole range of lookback lengths, from a minimum of 2 bars up to a maximum of 24 bars by default. For each of those lengths, it measures two things. First, the upswing, which is how far the current high sits above the lowest low across that window. Second, the downswing, which is how far the highest high sits above the current low. Each of these distances is then divided by the random walk expectation, which is the ATR multiplied by the square root of the lookback length. The strategy keeps the largest upswing ratio and calls it RWI high, and the largest downswing ratio, which it calls RWI low. Here's the intuition. A value of 1 means the move is exactly what pure randomness would predict. A value above 1 means the move is larger than randomness can explain. That's why the strategy uses a threshold, set to 1.20 by default. Only when a reading climbs above that threshold does the strategy consider the move statistically meaningful. Now for the entry logic. The strategy signals along when RWI high freshly crosses up through the threshold, meaning it was at or below the level on the previous bar and above it now. And at the same time, RWI high is greater than RWI low. In plain English, the up move has just become significant and it dominates the down move. The strategy signals a short in the mirror image situation. RWI low freshly crosses up through the threshold, and RWI low is greater than RWI high. Using a fresh cross means the strategy aims to join the moment a trend emerges, rather than chasing one that's already mature. Finally, risk management. Every trade gets a stop-loss placed 2 ATRs away from entry, and a take-profit placed 3 ATRs away, giving a reward-to-risk ratio of 3:2. The strategy holds only one position per magic number at a time and uses a fixed lot size. Simple, symmetric, and rule-based. Let's read through the code as it appears in MetaEditor. At the top are the input parameters you can adjust in the strategy tester. MinLookback and MaxLookback define the range of swing lengths the random walk index examines, from 2 up to 24 bars. Threshold, set to 1.20, is the significance level a reading must exceed. ATR period is 14, the length used both as the typical bar range and for sizing the stop and target. AtrSL multiple and AtrTp multiple are the stop and target multipliers, 2 and 3. Lots is the fixed trade size, and magic tags the EA zone positions. Now look at the signal block. The two Boolean variables, cross up high and cross up low, each check the same thing for their side. Was the reading at or below the threshold on the previous bar, and is it above the threshold now? That's the fresh cross condition. Below that, go long is true only when RWI high makes that fresh cross and also stands above RWI low. Its mirror, go short, is true when RWI low makes the fresh cross and stands above RWI high. Look at the long branch. When the condition is met, the strategy takes the current ask price, sets the stop loss 2 ATRs below it, sets the take profit 3 ATRs above it, and calls trade.buy. The short branch is the exact mirror. It takes the bid price, places the stop 2 ATRs above, the target 3 ATRs below, and calls trade.sell. Both sides are symmetric, clean, and fully rule-based. Let's bring this to life on the chart. On top you see the price candles, and in the panel below sits the random walk index, with two lines. The green line is RWI high, tracking the strength of the upswing, and the red line is RWI low, tracking the downswing. The dashed gold level is the threshold at 1.20, and the shaded band above it is where a move becomes statistically significant. Watch the first three candles. Price is drifting sideways in a tight, choppy range. Down in the panel, both RWI lines are low, sitting well below the threshold. This is exactly the random noise the strategy is designed to sit out. Neither the upswing nor the downswing has done anything a coin flip couldn't explain, so the strategy patiently waits. Now look at the fourth candle. Price pushes up with a strong close, and something important happens in the panel. The green RWI high line jumps and crosses up through the threshold, while the red RWI low line stays flat near the bottom. That is the exact condition the strategy is watching for. A fresh cross above 1.20, with RWI high leading RWI low. The up move has just become larger than randomness can explain, and a trend is emerging from the noise. That's where the buy entry marker appears, and the strategy opens along. The stop loss is set 2 ATRs below, and the take profit 3 ATRs above, that 3-2 reward to risk shape we described earlier. Follow the next candles. Price climbs steadily, one higher high after another, and the green RWI high line keeps rising, deep into the significant zone. This confirms the trend is real and holding. By the sixth candle, price reaches the take profit target, and the long trade closes at a profit in this illustration. Notice how joining the move early let the trade ride the cleanest part of the push. Now the market shifts. Around the seventh and eighth candles, price stalls, rolls over, and starts printing lower lows. Down in the panel, the story flips. The green RWI high line fades back below the threshold, while the red RWI low line surges upward and crosses above 1.20. This time, RWI low is the dominant line. That's the mirror condition, and the sell entry marker appears as the strategy opens a short. Just as before, the stop sits 2 ATRs on the risk side, and the target 3 ATRs in the direction of the move. From there, price falls through the following candles, each one carving a fresh low, while the red RWI low line stays elevated in the significant zone. By the 11th candle, price reaches the downside take profit target, and the short trade closes in this example. Two trades, one long and one short. Each entered the moment the random walk index confirmed a real trend emerging, and each exited at a rule-based target. Of course, not every signal plays out this cleanly. This is a teaching illustration, and real markets bring losing trades too. And that's random walk index trend emergence. We covered the core idea of comparing real price movement against a random walk expectation, how the average true range acts as the measuring stick, and how RWI high and RWI low signal an emerging trend when they freshly cross the threshold. We walked through the long and short logic, the ATR-based stop and target, and the actual MQL5 code behind it all. Remember, everything here is educational information only, not financial advice. and not a recommendation to trade. All trading carries risk, and losses do happen. If you found this helpful, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and drop a comment with the strategy you'd like us to explore next. Learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.